when are you boys planning on selling all these deals? And we're like, oh, well, sir, we underwrite a 7-year hold, and, gave him our metrics. And his response was so simple and so profound. He's like, well, the problem with selling, right? And I was like, no, what's the problem with selling? He's like, you don't own it anymore. And I walked away from that, scratching my head. I told my partners about it. And there was a time and a place to sell, of course, but so many wealthy people have become wealthy by accumulating real estate and just operating it efficiently and not selling. So
that might be my favorite. It's definitely my new favorite real estate quote, if not my favorite of all time. I say, my preferred hold period for a real estate asset is 100 years. And when I say that, people go, what the hell are you talking about? And I go, I really, legitimately, that's not a soundbite. I know that property is going to be worth a heck of a lot more to my kids and their kids than it is to me. Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle, and today's guest is Jacob Vanderslice. Jacob is a principal at VanWest Partners. That's a Denver-based real estate investment firm focusing on the acquisition and management of self-storage centers and other opportunistic real estate investments all throughout the United States. They have over 238 million in real estate assets, and I'm super excited to spend some time and introduce you to Jacob. So welcome to the show, Jacob.
Good afternoon, Josh. Thanks for having us on. Happy to be here.
Really excited to introduce, I don't think I've ever had anybody on the podcast who specialized in storage units. It's an asset class that I have always been interested in, but to be honest, I kind of felt like everybody knows it's a good asset class and they've all beat me. So I'm really interested to learn more from you today, but why don't we just start out with, tell us a little about your background. How'd you get into real estate and this niche around self-storage units?
Well, I've always wanted to be an entrepreneur. I was in the fire service out of college, and I had a bunch of time on my hands back in the mid-2000s. So I started doing some rentals and fix and flips on my days off. And I got busy doing those, and I quit my fire job in 2006 and kind of just kept going. That was a tough time to get into real estate in your early 20s with no financial background or training. Took a lot of lumps, but learned so much. And everything that we've learned over the years has really been just by making mistakes and failing.
Yeah.
You forget the successes like they were yesterday, but you remember you forget the successes, but you remember the failures like they were yesterday.
Right.
So we scaled that up over time, and we did over 1,200 single family fix and flips over the years. We did some townhome development, some adaptive reuse retail, and we had looked at self-storage for a while, and we liked the story. It's an asset class that we knew something about, but we had never done a deal in the space before. And we kind of jumped in headfirst with a development project in Denver in 2015, and did another development project in Denver, did some more value add deals, did an office reposition from office into storage. Then we expanded to the Milwaukee market. We did some value add deals out there in 16 and 17. We just kind of kept going. And we didn't jump into the space thinking, all right, we're going to make this fundamental shift from being primarily a residential investor to a self-storage investor. It was more just, let's try a deal out and let's do a second deal. And the evolution over time, as most entrepreneurial stories go, is we just kind of became primarily a self-storage owner, operator, and investment shop. So through today, we've got just under 17,000 units, 36 facilities, about 2.6 million square feet. And we're doing a combination of value add acquisition opportunities, but also ground up development projects as well.
Well, you bring up a lot of interesting, what I'll call wisdom in that kind of opening monologue there. And I just want to kind of highlight a few things. Number one, you and I were just talking about entrepreneurship, never being easy, but always being interesting and fun. And I think a necessary precursor to entrepreneurship, and I would include investing in any real estate asset class, especially if you're self-managing as part of that entrepreneurship, it requires a willingness to fail, doesn't it?
Absolutely. Absolutely does. Yes. And as you get, we like to say that we've gotten less stupid over the years, not necessarily
I love that.
less dumb. And we've kind of learned what not to do many, many times over and over again. And we're going to make mistakes. I'm sure we've made mistakes that we don't know about right now in our portfolio. But yeah, it's a willingness to fail, but also setting yourself up to mitigate the potential for failure as much as possible. Every investment has risk. Running your own shop has risk. But protecting against that risk is what we all endeavor to do. And that's what we think about every day. We want to create wealth, but even more than creating wealth, we want to protect our principal and our investors' principal too.
I think there's a lesson here for younger investors that are just getting started. I've watched a lot of people have analysis paralysis, where they're going to read all the books, they're going to ask all the questions, they're going to go to the seminars, but they can never pull the trigger. And the problem with that, or the disadvantage of that, is that you don't get to learn the lessons that come from the mistakes when the stakes are small. And then at a certain point, I've seen people get to feeling like they're so far behind that they got to push all the chips on the table now, and they've got to go big. They have to hit a home run. And now they haven't learned all the mistakes from the little deals when the stakes were smaller. Does that resonate with you in your journey?
Absolutely. And first of all, the home runs, you never knew it was going to be as good as it was. And often the home runs came down to, let's face it, timing and luck. Events that you could never quantify happening, events that you never would have modeled in your spreadsheet that take place. And if the deal's a home run, it might be because you're a good operator and you're intelligent and you protect the downside, but it also might be because you're lucky. And typically 100%. It's a combination of kind of both. And to your point earlier about folks, and I was this way for a long time too, who were just buying the books, listening to podcasts, going to seminars, and just thinking about things a lot and not actually taking action. Your greatest asset is your time. And creating wealth involves you placing your capital into an asset and using the years it's in that asset to grow in its value. And if you're not doing that, you're not using your time wisely. There's no perfect investment. There's no investment that's perfectly downside protected. But as they say, you're not scoring points if you're not playing in the field, right? So you've got to take a risk and take action. It's buying a single family rental, investing in a third party syndication or fund. That's how you learn. And there's risk in that learning for sure. But if you lose a little bit of money, you might learn a lot more in exchange for losing a little bit of money than you would have using that same capital to buy educational materials that you never do anything with.
Yes. I think as I look back over 24 years of investing, I think the risk of not having time in the market, meaning controlling an asset over a long period of time, the risk of missing out on that is greater than the risk of mistiming a purchase or a sale. As I look back over 24 years, we made average buys at the time. And for the first 10 years, you'd go, it was okay. We invested a lot of money back into it. We're probably net positive, but certainly not as good as Bitcoin or Tesla. But when I look back over that, I mentioned to you earlier before we kicked into the show that the first property my mom and I bought was 24 years ago. We 1031 that, exchanged that into an 8-unit small apartment building 22 years ago. Now, if you look at that asset, you go, that's a home run. But it wasn't a home run for 15 years. At year 15 on, now it's a home run. And that just goes to that saying, it's not timing the market, it's time in the market that makes the big difference.
Yeah, one quote I've heard several times is everything's a deal in 20 years.
That's right.
And we've been guilty in our real estate investing careers. Among the many mistakes we've made, one consistent one that we were making is being overly transactional, which means we were buying, making better, and selling too often and too quickly. And that creates income, it creates cash, and it builds up equity. it's very tax disadvantaged. It's very non-tax advantageous, I should say. And you're kind of being a trader versus an investor.
Yes.
So we shifted our thesis 4 or 5 years ago to accumulating assets and holding them for a long time and enjoying the benefits of the cash flow and depreciation and tax advantages that asset base produces. We philosophically are not a good seller. We don't like selling. We'll sell when the time's appropriate, when enough value's been created, but we don't try to sell anything that we absolutely don't think is going to be a home run. And frankly, we haven't tried to sell anything for a while just because we're in accumulation mode. One of our investors, pretty elderly guy with a lot of money, filled out one of our web forms on our website. We schedule a Zoom call, and I call him up, and he's like, when are you boys planning on selling all these deals? And we're like, oh, well, sir, we underwrite a 7-year hold, and gave him our metrics, and his response was so simple and so profound. He's like, well, the problem with selling, right? And I was like, no, what's the problem with selling? He's like, you don't own it anymore. And I walked away from that scratching my head. I told my partners about it, and there was a time and a place to sell, of course, but so many wealthy people have become wealthy by accumulating real estate and just operating it efficiently and not selling. So
that might be my favorite. It's definitely my new favorite real estate quote, if not my favorite of all time. I say, my preferred hold period for a real estate asset is 100 years. And when I say that, people go, what the hell are you talking about? And I go, I really, legitimately, that's not a soundbite. I know that property is going to be worth a heck of a lot more to my kids and their kids than it is to me. And if I can instill that type of thinking in my children, then I've won. I believe that those properties are already theirs. It's part of the legacy and inheritance that I'll leave them, is not just the asset, but the knowledge that comes along with managing and holding that asset for a very long period of time. And if I have a 100-year timeline of that asset, I hope that will transcend onto them, and they'll become long-term thinkers and not transactional thinkers. So boy, there's just a tremendous amount of wisdom there. Thanks for uncorking that for us.
Sure.
Well, so, Jacob, this is interesting. I guess it's always an interesting time, but there is a lot of crazy macroeconomic events going on. Everything from inflation at historically high levels, the Fed seeming to never pause. I mean, maybe we're just going to be in 25 basis point rises for forever until they've squashed inflation. We'll see how that goes. What looks to be a slowing economy, potential upcoming recession. We've got Ukraine. We've got blimps being shot out of the air that are suspected to belong to China. I mean, there's just so much chaos in the world that I feel sometimes that puts people in a place where they just pause and don't make any decisions. How are you thinking about today's world events?
Well, I'll answer that question, but I'll latch on to one thing you said for a moment. Investor sentiment right now is confused and concerned and fearful. And as you mentioned, the confused mind makes no decision. So people are really have a lot of pause investing in private real estate vehicles, buying rentals, whatever the case might be, just deploying their capital into the real estate space. And my response to that is there's never a good time to buy, and there's never a bad time to buy. There's good deals and there's bad deals, and that's it. You can buy in the most inflated environment ever and still buy a good deal. And if there's a complete meltdown, you can steal assets at a discount and probably come out the other side even better. So as far as what we see coming up here, it feels like in recent history, the macroeconomic meltdowns that we've seen have been tough to compare to prior events, right? You've got the financial crisis in 2008, you've got COVID, you've got whatever might be coming on the horizon now. I'm a big history person, and I read a lot of historic nonfiction books. And I do believe that looking at past events can help us understand where we're going. But the world has changed so much, and it continues to change. It's hard to compare what's about to happen to, say, the financial crisis or the dot-com boom or the S&L crisis in the 80s. I guess regarding the looming recession. So the numbers are just not out there yet that there's a recession coming. Now, I don't believe most of what the government reports to us, but let's face it, that's the data source that we have. Job growth was triple, 2 or 3 weeks ago, what they had forecasted. Unemployment's at historic lows. And yeah, the Dow's down, but unemployment's low and wage growth is strong, and people who want to get a job can get a job. And frankly, there are a lot more job openings than there are job candidates out there. So where's the story for the recession? Like in Park City, I'm sure you go into a restaurant, which is where you are. You can't get a reservation. People are swiping their credit cards. They're buying steak. They're buying wine. You drive down the interstate here in Denver, 1 out of 10 cars on the highway has got a temp tag on it. New cars are trading for over MSRP. It feels like there's a lot of wealth out there still, and there's not much pain. Well, what's going to precipitate that pain if it does come? And as it relates to real estate, the big concern, notwithstanding geopolitical events like in Ukraine and how that's going to affect the world economy, notwithstanding alien balloons that are coming over our northern border, whatever those might be. By the way, I can't wait till they tell us what these things actually are. It's going to be fascinating. We know the China balloon, obviously, but what are the other ones? I think the big crisis in real estate, though, is a debt crisis. You've got liquidity drying up in the lending system, in the capital markets system, and it's not necessarily because it's not there. It's because lenders are fearful. So you've got a reduction in loan proceeds. If a lender was lending at 75% a year ago, they're down to 60. If they were giving you 10-year terms a year ago, at least in our space, terms are now down to 5 years. Development loans, if you're trying to build a project anywhere, development's really tough to get done right now on the debt side. So a lot of transactions are not happening that would have happened a year ago. So what we see happening this year, and I think, first of all, predictions are wrong, so don't listen to anything I'm going to say. But second of all, this prediction, I think it kind of transcends asset classes. It's not just storage specific, it's multifamily, industrial, hospitality. You've got a good story for continued reduced transaction volume. So sellers who don't have to sell aren't going to sell because buyers can't make their models work at their pricing. Yep. And then sellers who are not sellers yet are going to become sellers, whether they want to or not, eventually. And I think that's going to happen not only because of my comment about just debt in general, but floating rate debt. That is the big underlying, I think, if there is a time bomb in the real estate market, that's the time bomb right there. You've got borrowers that originated and borrowed loans a couple of years ago on floating rates, and their interest carry is in many cases more than doubled, almost tripled. Yep. So they might have hit their revenue growth targets and maybe even exceeded those. But 65 or 70% of their capital stack, the cost of that capital is doubled over a pretty short period. So what's going to happen when their debt matures is, for those of us listening who don't know what a bridge loan is, it's a shorter term loan, typically a floating rate. Your payment changes based on SOFR or the 10-year treasury, whatever it might be. So your loan's going to mature pretty soon. So what are you going to do? Well, if you refi into term debt, your proceeds are going to be low and your interest rate's going to be even higher than your floating rate loan. So you have to bring equity to the table or you sell. So I think we're going to see the theme for this year, we believe, is going to be reduced transaction volume and potentially more heavily discounted deals that do transact compared to, say, a year ago. Beyond that, that's all real estate related, of course, but we're coming out of this era of irrational exuberance, right? Record increasing rents, compressed cap rates, historically low interest rates. That's all over. And whether the numbers are showing that it's over or not yet, it has to be over in this debt environment. You can't finance at a 7 and pay a 4 cap, right? Just doesn't work. No one's going to give you a loan, even if you want to do that. So it's going to be interesting to see how this plays out. One thing we're watching for really carefully in our portfolio is our consumer demand. So how many of our customers are still storing? Are they current on their bills? Are they digesting customer rate increases, which is a big component of value creation in storage? So yeah, a lot of uncertainty. And our targets for this year is not deploy X millions of dollars or buy X number of deals. our target is to buy good deals. And if we don't see good deals, we're not going to buy anything. So we'll see how the 23 plays out. But this is the beginning of a big shift, in my opinion.
I think what you're describing is exactly right. It's funny, I just text messaged a few of my real estate investor buddies. Real estate investors always have real estate investor buddies, and we just always trade content and articles back and forth. This morning was my turn. And the article came out of Bloomberg. Brookfield, which is the parent entity of the largest office landlord in downtown Los Angeles, defaulting on 2 sets of loans tied to massive, there's pictures of them. You're talking about massive 60, 70, 80 story high skyscrapers in downtown Los Angeles. And they're talking about occupancy rates that still on a regular basis are less than 50% in terms of people coming into the office. And at a certain point, it's just not going to make sense. So you layer that potential situation over the rise in interest rates. And there's something that I think we should point out here, Jacob. What you and I are talking about is the risk associated in the commercial real estate lending world associated with floating rates, or perhaps there'd be a fixed term for 5, 7, 10 years, and then that loan needs to be paid off or refinanced. That's very different than what's happening right now in the residential world, because in the residential world, first of all, 1/3 of all U.S. homes are owned free and clear. Of the 2/3 that are financed, 80% of that debt is financed below 4% rate. So you're talking 4, 3.5, 3% tranches. And 90% of those loans are fixed rate loans. So they're 10, 15, 20, 30-year fixed loans. So what Jacob is describing in the commercial world is kind of what the residential world went through in 2006, 2008, because there were all those loans that were done with, let's call it loose underwriting guidelines. That's probably being generous. But the scrutiny certainly wasn't there in terms of a borrower's ability to repay. And then those loans were sold with 1, 2, or 3 year initial fixed periods. And then they often had 3, 4, or 5 year prepayment penalties. So the loan rates would fluctuate higher. People were trapped in them because of the prepayment penalties. Then you had a drawdown in the amount of equity in the homes. People couldn't get out of them. It resulted in a little bit of a big ticking time bomb. But that's kind of what you're potentially seeing or forecasting in some areas of the commercial world. Did I get that right?
Yeah, and I think that's a good comparison to make for sure. I don't expect the meltdown in commercial real estate, if there is even a meltdown, to be anywhere close to what it was in residential during the great financial crisis. But there's going to be some pain. And yeah. I saw the same article you just mentioned this morning. Brookfield is a juggernaut of real estate capitalism. They are a massive company. And not only, as you mentioned, are they defaulting on a senior loan, they have mezzanine debt behind that and junior mezzanine debt behind the mezzanine debt. So these things are levered up, hundreds of millions of dollars. And their default, I assume, is not necessarily because they're not paying their mortgage. Their default, I think, is their loans maturing and they can't refinance out of it. So in commercial real estate, you can be in technical default, which means that you've missed a loan requirement or loan covenant within your loan agreement with your lender. You can be in default and still making your mortgage payment. So we'll see how the banks work with them. But sometimes when you have that much debt, the banks need you to perform more than you need the bank to be good to you. So that'll be a fun one to watch.
Yeah, it's going to be interesting. Would you just quickly explain mezzanine financing so that everybody that's listening understands that?
Yeah. In real estate finance, the different types of capital that are in a given deal, we call the capital stack. In a typical capital stack, you've got senior debt and you've got common equity. And common equity you could look at as the down payment. So you finance 65% with the bank, you bring 35% in cash to the deal. That's your common equity, that's your senior debt. Well, there's lots of ways to slice and dice the different pieces of that capital stack. So mezzanine debt simply means that it's a debt component that sits behind the senior bank debt and in front of the common equity. So the bank debt gets paid first, the mezzanine debt gets paid second, and the common equity gets paid third. Now, mezzanine debt is an instrument that people often use to juice the returns of the common equity, because if you have higher leverage, your down payment's lower, and your return on that equity could potentially be exponentially higher if the deal goes well than it would be had you had lower leverage. Well, when the deal doesn't go well, like these Brookfield office towers in LA, you find yourself levered up with a very high cost of capital and high debt service, and you might not have much equity in the property, but now he's probably going to get wiped because those lenders have to get paid before your equity does. So that's mezzanine debt. Basically sits between the senior debt and the common equity, and it's a mechanism that's often used to juice deal returns.
Yep. And for folks in the residential world, to make this a little simpler, that's not any different than I have a first mortgage with my bank, I have a home equity line with my credit union, or perhaps mom and dad loaned me money that they have on a second position right to that property. And then after those two are paid off, then whatever's left is my equity as the owner of that home. So you can kind of think of it in the same way, just a little more sophisticated in the commercial world, but fundamentally same concept.
Exactly. Yep.
All right. This has been a fascinating conversation so far. I'm really enjoying it.
Yeah, I love the wandering we're doing. I'm having fun here.
I know. I'm digging it. I think this is going to be really valuable to people. Let's talk about the self-storage business. So you kind of told us how you got into that. And as you were explaining that, I was thinking of the Steve Jobs commencement speech at Stanford, where he says, you can't connect the dots looking forward. You can only connect the dots looking backwards. And you just kind of bravely have to go build the path. And it seems like that's how you got into that niche. Educate us on that. Why did that become the path for VanWest? And why do you see that as your focal point in an area that you continue to put capital into?
We like the industry because it's historically downside protected, and it's got what we believe to be a very attractive risk-adjusted return. And risk-adjusted returns simply mean, I'm sure a lot of us listening have come across the term IRR, or internal rate of return. And I'm not going to go too far in the weeds here. Don't worry, Josh, or listeners. IRR stands for internal rate of return. It's simply a calculation based on a time-weighted series of cash flows. So it's a return profile based on time. So look at it, it's kind of like an annualized return as well. So if you look at a deal that's a 25% IRR and you look at one that's a 15, you might do the 25 because it's a higher IRR, right? Well, what's driving that return target? How much risk is implemented into that model that gets to that return? Is it a short-term low cap rate exit? Is it aggressive revenue growth? So we try to blend a healthy IRR. We typically land in the mid to high teens targeted, with a strategy that's downside protected, that's reasonable, achievable, and quantifiable. And we found that over time in self-storage. So one of the many reasons we like it is the granularity of the revenue streams. So we're relying on thousands of our customers to pay us $50 to $300 a month, sometimes a little bit higher depending on the unit type. And the chances that a big portion of them are going to roll over on you or move out or default all at the same time are very low. So we have these very bite-sized incremental revenue streams that add up to be meaningful across the portfolio, but on an individual gross dollar monthly nut basis, our customers are not paying us very much money to store their goods at our facilities. We also like the fact that when there's typically a disruption event like COVID, the financial crisis, a possible recession in 2023 or 2024, we'll see when there's a disruption event, consumer demand typically increases. And the reason is when there's a downturn, people start moving up and down the economic ladder faster. People are getting married, they're getting divorced, they're upsizing or downsizing their homes, they're losing a job, getting a new job, they're relocating. The need for storage increases. And that's why we feel like it's fairly downside protected. But in a sentence, we like storage because storage offers durable, recurring, repeatable revenue streams. And we are very, very cash flow focused. We might take different paths to get to that cash flow. It might be a development deal or a lease-up acquisition where that cash flow isn't going to be realized for a while. But our target is always cash flow. And we feel like it's an industry that's got reliable, durable income streams.
I love that. I've never heard that saying before, granular income streams. But as you explained that you've got hundreds or thousands of tenants that are paying small incremental amounts each month, and the chances of thousands of them getting wiped out at the same time are very low, versus if you had one anchor tenant that decided to move, go out of business, not renew their lease because 50% of their workforce is working from home, then you've got a significant loss potentially in a tough market that is take you years to release. That's a really interesting concept that I think I've thought of from an apartment building, but never as clear in my thinking as you just articulated it. That was really well done.
Apartment buildings have elements of granular revenue streams, and they've got the benefit of one of the last bills you stop paying is your housing bill, right? You're going to stop paying your storage bill before you stop paying your apartment rent. But one extreme example might be the office towers that Brookfield's in that we just talked about a few minutes ago. For example, I don't know this, but there's probably a floor plate on one of those office towers that a tenant didn't renew their lease on. And that tenant, I bet, was paying 300 grand a month in rent, something like that, all in. So that's a lot of income. And for them to replace a new tenant, we won't go too deep into the office industry here, but office is very capital intensive. So to get a tenant, you have to offer something called a tenant improvement allowance, which means you're giving them money to refurbish the space how they want it. And that could be $100 a foot, which could translate to millions of dollars. So not only do you have a upfront capital outlay of millions of dollars, it's going to take you a couple of years to find a new tenant to replace that. And multifamily, some markets are a little bit different, but if someone doesn't pay, you go through the eviction process, you put a new tenant in there. And storage, someone doesn't pay, we just lock them out, auction their stuff, put a new customer in that pays. So you're not getting a giant revenue stream off of one tenant or one group. You're getting a giant revenue stream off of thousands of them. And that's one of the reasons we like it.
Very well articulated. Thanks, Jacob. That really helped me personally a lot think through the advantages of storage. So how do you find storage opportunities? I would imagine that there's a lot of competition out there. What's the process by which you locate and find properties?
Well, despite the uncertainty, deal flow remains challenging. And another comment that I think transcends asset classes, there is still a pretty wide bid-ask spread between buyers and sellers. And the same thing in self-storage. So just over 70% of our deal flow in the last 12 months has come from off-market sources, and off-market is not a term that I use lightly. We all throw around off-market in the real estate industry, and often an off-market deal is not really off-market. We have a great broker network who will engage with sellers and take them to us first. And if we can hit the price they want, nobody else sees it. We bought a lot of deals that we believe be pretty big discounts there. If it's a deal that's widely marketed through a professional brokerage shop, it's national, we almost never can compete. There are too many other operators and buyers out there who either implement more aggressive underwriting assumptions or their return targets are lower, or both. And we'll miss widely marketed deals by millions and millions of dollars. So most of our stuff's off market. The stuff that is on market is poorly marketed. Maybe someone's got a cousin who's a residential broker and they put their storage facility in the MLS and nobody sees it. So we'll see deals like that here and there, but deal flow remains challenging, and the deals that we are sourcing for the most part are coming just from relationships we've had for a long time.
So that's great. Walk us through let's pretend that somebody is an investor and they are interested in investing with VanWest, and they love this idea of the granular income streams, the diversification. They love your process. They see your backstory. They see the evidence of success. How is that investor protected? Walk us through a standard deal in terms of how much equity versus how much debt? What does the debt stack look like? Help people understand how they are protected and rewarded for investing with you.
Yeah. And I'll keep this fairly high level, but on the debt stack side or the leverage side, one thing we care most about as far as debt metrics is loan to cost, or LTC. People throw out the term LTV a lot. LTV stands for loan to value. Value is subjective and impure. Whose value is it? Is it my value? Is it the appraiser? No offense to any appraisers listening, but we don't put a lot of weight on appraisals. It's a necessary element we have to get a bank loan. But V, or value, is subjective. Cost is pure. So we leverage our properties between 60 to 65% of cost, or loan to cost. So fund one's about 50, fund two is about 62, and fund three is 65. That's kind of our sweet spot on the leverage side. And if you're looking at private real estate vehicles, be they single asset syndications or funds, one common element is something called preferred return. And preferred return is designed to get investors up to a certain per annum yield before anything else happens. In the case of our fund, it's 8%. And then typically after a preferred return is paid, there's a split with the investors and the sponsor, which is generally much more in favor of investors. Sometimes we see it the other way. But the split the sponsor gets is their reward for going out and executing the strategy, basically. So in the case of our fund, we have a 3-tiered waterfall, and a waterfall simply means how are cash flows paid. So tier 1 is preferred return of 8%. Tier 2 is return of capital, which means that everything after 8% goes to return investor capital accounts. Said otherwise, our investors get 100% of our distributions we make until preferred return is current and until their money's back. And then third, it's 80-20 in favor of investors based on their capital in the fund. So that's our waterfall. So they're getting most of the side. They're downside protected by virtue of our experience in the industry and also our leverage. We find that kind of low to mid 60s on loan to cost is a sweet spot between being conservative on your leverage, but also being efficient with your equity. As we talked about earlier, the lower the equity in the deal, the higher the return on equity could be if the deal goes well. But the higher chances that equity can be wiped out if the deal doesn't go well. So yeah, that's how we're generally set up. And our philosophy in real estate investing, whether it's self-storage or anything else, is buying deals that are undermanaged, investing in deals that are merit-based versus speculative. We're not buying something saying it's just going to go up in value and then we're going to sell it in 5 years. We're assuming it's going to increase in value, but we're making it increase in value by virtue of increasing revenue streams and controlling expenses. So that's how we're set up. Whether you're looking at storage or multifamily or industrial, I think third-party private syndications and funds are a great way for folks to get exposure to a space they otherwise may not. You may not have the time or the money to go out and invest in an apartment building yourself, but you might have $100,000 where you could park it with a trusted sponsor and get most of the upside and enjoy the same benefits of owning it yourself, just with a smaller piece.
Yes. I want to dig into that debt stack just a little bit more and the 3 tiers of those payouts that you mentioned. I find it really interesting. So in today's market, if you're going to secure 50 to 65% loan to cost, what type of a interest rate are you securing from a bank on that? Just ballpark.
Well, let's go back to April of 22 when we launched Fund 3. Our first loan in April of 22 was 3.75%. Our last loan of 22, we haven't closed any deals in 23. We're recording this in February. Our last deal we closed in 22, our interest rate was 6.5%. So it's gone up quite a bit. So we expect term debt rates to more or less peak around 7. There could be a little more runway to go up there depending on what the Fed does, which none of us can predict, obviously. But you might wonder, how are you buying deals at 3.75 and then making deals work at 6.5%? Well, we often say that you date the debt and marry the deal. We are buying deals based on deal level fundamentals. Now, the debt in the short term has to make sense from a cash flow perspective, from a coverage ratio perspective, but debt is temporary. You're not going to have that debt forever. Like any other operator, I'm sure, yourself included, Josh, when appropriate, you guys probably refinance and pull some cash out. Rates drop, create value. And when you pull that cash out, let's say you pull it out at a 5% interest rate, can you beat a 5 investing in somewhere else, in something else? Probably, right? That's probably not a tough return to beat. So yeah, our interest rates have gone up. The deal fundamentals are still sound, but the big impact that we've seen on interest rates is short-term distributable cash flow. So in investor expectations, we've shifted our investor expectations over the last year to helping them understand that this is not an environment where you're going to see a meaningful amount of front-loaded cash flow. It just doesn't exist right now if you're investing equity in a real estate acquisition. It will exist again, hopefully not too far in the distant future, but the days of immediate cash flow until asset values decline or until interest rates go down are definitely different than they were a year ago.
Yeah, that makes a lot of sense. So you talked about those tiers of investor return being one, the 8% preferred return. Are you still able to pay those out with the interest rates that you secured in the end of 2022?
So the way that preferred return works, which I'm sure you know, Josh, but for everybody listening, preferred return accrues towards investor capital accounts. And it is, whether it's paid current or not, it's still due to them when there's enough net income to pay it. So in Fund 3, we're doing a combination of heavy value add deals, but also income deals. So for example, we bought a new construction deal that was at 40% occupancy in July, and we've taken it up to 60. So the leasing velocity is great, but 60% physical is not enough to start distributions.
Right.
So to answer your question more succinctly, the portfolio is not yet generating enough net income to pay full preferred return, but that's by design. If you're investing in a development deal, for example, and there's a preferred return component in the syndication, you can't expect to get a distribution on that for years.
Right.
You got to build it, right? There's no income when you're building. In fact, it's a loss. Then you got to lease it up. And it's still losing money during lease up because the income does not pay the expenses. So yeah, we're ahead of where we thought we would be from an income perspective this early on in the new fund, but we haven't started distributions yet.
Great, that was super helpful. And honestly, I a lot of this you're teaching me to a depth that I understood at a surface level, but not nearly as deeply as I do having talked to you now. So I appreciate it. These questions are legitimate curiosity, and you're teaching me a ton. So then, you talked about the second means by which investors are paid is return of their capital. And I'd love to just touch on that a little bit, because I believe as you return that initial capital investment to them, that is not a taxable event. They're simply taking a distribution, and since it's less up to the point that it's less than their initial investment, there'd be no tax on that, correct?
So I'll answer that question, but there are two events in our structure that would cause a return of capital, not including a sale. Obviously, a sale would cause a return of capital, hopefully, right?
Yep.
One event is excess income over 8%.
Yep.
So if you look at that 8% bucket of water and it fills up, it spills over to the return of capital bucket. And the second event would be a refinance, and that's simply replacing investor equity with bank debt. So if you own a house, it's worth $1 million, you owe $500K in the house, you could get a loan on it for $750, you could pay off the $500, walk with $250 in cash, distribute that to whoever you want to. As it relates to your tax question, it depends on the return of capital event. So if that return of capital event is a result of income, that unfortunately is taxable. If it's a return of capital event as a result of a refinance proceeds are not taxable. Now, even though a return of capital event resulting from income would be taxable, as you know, depreciation in real estate often washes out current tax liability, either substantially, if not completely. So that's one of the benefits of owning real estate for the long haul versus trading in and out of it, is you're enjoying that depreciation benefit and offsetting the cash flow you're receiving and potentially not paying taxes on that during the whole period.
So the entity that holds the asset is probably doing a tax segregation study and then depreciating on some sort of a bonus depreciation schedule. That is reducing the income of the entity. And then therefore that would reduce the amount of K1 distribution that I would have to pay taxes on as an investor. Am I close?
Yeah, correct. Yeah, the way we're structured, this is pretty common in most syndications or funds you might look at, but 100% of our depreciation flows through to investors pro rata with their contributed capital. So if you're 1% of a given deal, for example, you're getting 1% of the depreciation. And on a K1 basis, you might have gotten on a $100,000 investment, for example, you might have gotten $8,000 in a given year in distributions, but your K1 shows very low, zero, or possibly negative income. So one of the benefits of participating in real estate is, again, depreciation reduces your taxable income.
There's nothing better than putting dollars in your bank accounts and then getting a negative distribution on a K1 from a real estate entity, by the way. That is what winning looks like. That's
the game we play. Agreed. Agreed.
So the third distribution mechanism, we have the 8% preferred, then there's a return of capital. And then once that return of capital is to the initial investment, then there's a distribution at 80-20. And I would assume that the ownership percentage in the entity hasn't changed, even though the investors got back their return of capital. But can you just clarify that for me?
Yeah, correct. There's no dilution or diminishment of investor shares by virtue of the fact their capital has been returned. They still own the same number of shares they owned before. Assuming their preferred return is current and all their money has been returned to them, they're getting 80% of their pro rata ownership in the fund in every distribution the fund makes. So we designed it that way. We have to make something, right, for executing the strategy. And the piece of that we take is referred to as promoted interest or promote, sometimes called carried interest. But for us to get that interest, we have to make an 8 current, and we have to give everybody all their money back, either from operational cash flow, from a refinance, or from a sale. So you're correct. Ownership interest would be the same as it was when they initially invested.
So you have to do an extraordinarily great job as an operator in order for you to win in this equation. Your investors are going to win first.
Yep, exactly. We get some fees along the way that are designed to keep our lights on. We can't eat or promote, right? Because that's going to be happening years down the road. But yeah, aside from those nominal fees along the way, our big payday is on the back end, and that doesn't happen until investors are completely de-risked.
Keeps your interests completely aligned. That's great. I love that. So let's talk about kind of a worst case scenario where, well, two worst case scenarios. Worst case scenario number one, somebody dies, somebody gets divorced, somebody gets disease, and they need their liquidity. They need that capital back. Could you help us understand what the mechanism by which that could be accomplished? And then number two, and I'm only combining these because of the amount of time we have left. Number two, what is the instrument by which that initial investment is secured against loss?
Yeah, so you're asking about risks and kind of disadvantages. So yeah. I'll spin through a couple of them. We'll just be blunt here. Your risk is your invested capital. Mm-hmm. You have a risk of loss. So your main risk is you could lose all your money, right? That's the risk. You're an equity investor, you're an owner, you're a member of the LLC. It's like buying Amazon stock in December of 21, right? It couldn't be stopped. Well, now you're down. I'm not sure what the numbers are in Amazon, but 50%, I don't know, 40%. It's gone down a lot. So there's always a risk of loss. The other disadvantage that, at least in our fund, and I think a lot of private funds and syndications for that matter, is investors have a lack of liquidity. Going back to the Amazon example, it's not like selling your Amazon stock and getting a wire to your Schwab account the next day. So one of the things we often say when we onboard a new investor is, hey, for better or for worse, you're stuck with us for a while. If you want to get out before the fund is ready to get you out, we do have a mechanism where we could offer your shares for sale to other investors in the fund. No one's tried to do that before, but it certainly isn't something someone should rely on as a source of liquidity. So we tell everybody that once you invest with us, you're trapped for a while. For better or for worse, we're kind of attached at the hip. as far as how their investment's secured, they don't have a recorded lien against properties. So the only recorded liens we have is our senior bank debt, which ranges between 50 and 65, depending on the deal. But their owner in the fund is perfected by virtue of them buying membership in the fund entity. So they have shares in the fund as common equity. We touched on common equity a few minutes ago. But nowhere in our offering documents does it stipulate that their capital is secured against loss. If there's a wipeout of equity, let's say we're levered at 65%, we sell a property for 35% less than we paid for it, just enough to pay off the bank debt. That means investor equity in that deal would be wiped out. So those are the downsides.
Makes sense. You're an owner, just like if you're owner of a residential home, the bank gets paid. And if there's upside, you get it. If there's downside, you get that too.
Yep, exactly. Now we mitigate that risk in lots of different ways we don't have to go into, but a couple examples are what we believe to be reasonable, achievable, and conservative underwriting assumptions. Now, every model that we make on every acquisition is wrong. It's never going to go like you think it will. It's going to go better or it's going to go worse. But the assumptions we make in our models are not assumptions that if everything goes perfectly, this is your return. They're reasonable, they're achievable, they're quantifiable, rational. That's how we approach risk mitigation. And there's a lot of subjectivity that goes into that. Obviously, what's reasonable and achievable? Well, that's why you're relying on sponsors, multifamily sponsors, industrial, retail, self-storage. If you're investing in a fund or syndication, you're relying on their expertise to protect against downside.
Exactly right. Yeah, it's to a large degree, the protection that you have is the partner that you choose to partner with. And you're investing in the people as much as you are, if not more, than their deal. Yeah. Really well said. Really well said. Man, this has been extraordinarily fun. I know it's been a great podcast when we get to the end of the hour, and I feel like I could go for another hour at least. But we don't have another hour. We have 4 minutes. So in closing, Jacob, I always like to ask this question at the end of a podcast, and I find it kind of fascinating, the different answers that I get, actually. So let me ask you this as a closing question. What myth or sacred cow do you see about finances or investing that you wish people knew the truth about, or maybe you've discovered for yourself?
Well, I'll tie that question back into self-storage. A lot of people think that self-storage is fire and forget. No tenants, no toilets, no problems, no fair housing laws. And I'm not trying to dissuade people from either doing your own deal or investing in self-storage, of course, but that could not be further from the truth. Self-storage is operationally intensive. Yeah. We have thousands of customers moving in and moving out constantly. We have theft issues. We have break-ins. We have gate systems going down. We have natural disaster implications, employee retention issues. It's very much an operating business. Yeah. And all the challenges of the asset class are just like the challenges of any operating business, with lots of customers, with customer service, with things going wrong. But it's like anything in real estate. Creating wealth in real estate is not, first of all, easy. And second of all, it's not instant. It's a long game. And that's how we approach it. But yeah, self-storage is not an easy operational asset class, regardless of what you might have heard.
That's exactly the reason why we've never gotten into it, because you have to build a business before you can, or optimize a business perhaps before you can get into that asset class.
Yeah, we're a self-storage operator before we're a self-storage investor. Yeah,
that is exactly the right way to say it. This has been a lot of fun. Jacob, where can people find you if they want to contact you, if they want to have more information about your website? Where should they go?
Josh, I had a blast too. They can email me, jacob@vanwestpartners.com. Go to our website, vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Thanks a lot, my friend. Hope to have you back at a future episode. This was really exciting, and I'm sure everybody learned a lot today.
You're a pro. I enjoyed it.